In this video, traders are going to look at, do you really need level 2? Stay tuned. Hey guys, warm welcome to you. Alright, so do you really need a level 2 subscription? I'm going to look at the arguments for yes and no. So first of all, what is level 2? So a really brief overview. I've done a much more in-depth video about market depth, price ladder, level 2, all that kind of stuff. So level 2 is really one extra level, that's what I call level 2, where you can see the bids and offers stacked up in the order book. So all the limit sells, all the limit buys, the size and the price in the order book. And if you add time and sales into that, which is the trades going through, so as the trade is executed, it's print and shown. So let's say 100 shares go through at $90, you'll see that. Next share, say 500 shares go through at 90.02, you'll see that. So you can see the actual trade executions and the market depth, the depth of the market or the price ladder. Now, if you're talking about futures, same kind of thing. It's just generally displayed in a different way in an aggregate format in futures as opposed to in stocks, where you actually get each individual ECN, etc. And also depends if you're on LSE, New York Stock Exchange, etc. Anyway, we don't need to go into that. Hopefully you know what level 2 is. If not, go and check out some of the videos. So do you really need it? That's the question for this video. Now, I'm trying to sit on the fence here, because level 2 and reading the price action on level 2, time and sales, the market depth, is something that I spent many years doing, and it was something that was very good to me. I've spotted some really good edges in that. I did it on the London Stock Exchange, looked at it trading futures, all sorts of stuff, and it was really useful. I've kind of moved away from it a little bit more now. I still look at it from time to time, but I think that trying to extend my holding time means that I kind of don't look at that as much as I used to. That was very useful for short-term trading, especially when the algos were relatively new and you could spot the algos and you could kind of work orders around those algos. I think it was great. But listen, I don't think there's any right or wrong. I think it's personal preference. I could easily be going back and watching that in the next kind of couple of months, and you just change and go with your flow and how you feel. So I'm not saying that's going to be the way forever, but I just find myself using it less now than I perhaps did 10 years ago. Okay, so some of the pros and cons. So obviously the biggest pros, you can see the order book. Like, you can see all the orders in there, you can see what's going on, you can see the kind of levels. Now, it's not all it's cracked up to be. There's lots of games going on, lots of fake orders in there, lots of iceberg orders, stuff we can't see the true size. So it's not really that good on its own. However, you can see stuff like held bids and asks. So as the price is coming down, and let's say there's a big level there, you can see the actual level on the order book. It's hitting. There might be more liquidity there, might be thick liquidity, which you wouldn't be able to see on your chart. You wouldn't be able to see on there, and you don't know if it's being hit or not. You can see on the time and sales, maybe it's streaming red, but it's still not working its way through it. So there is that. Then you've got the reloaders. So those are the guys who it's hitting a level, someone else is, or they're reloading the size, and they're just providing support. So you can see that on level 2, which you might not be able to see on a chart. Now we'll come to that in a second, but you can actually physically see the orders coming back on, and being hit, reloading, and then you can potentially make a trade off that. And you can see liquidity as well. I mean, if liquidity is super thin, it might remind you there's economic data coming up as a really vague, rough example. It might be even like, okay, this liquidity is really thin. If we break this level, there's not much there. Again, that's a little bit misleading, because orders come in a flash, and half the people aren't showing their orders. They're going to put the orders in as the price gets to it automatically. So you've got to be careful with that. But it's something as well you can do. In sort of tandem with that, you can enter your limits easily. So you can quite easily find a spot where you can enter. Let's say you spotted something with only a few contracts and you were going to go maybe one tick lower, but there's a thick amount there, then maybe you're just going to go one higher just to make sure that you get priority, because one tick doesn't make a difference. But you couldn't do that if you didn't have level 2. You couldn't see a big thick order there, and you may want to front run that guy. And you can watch with time and sales, as I say, you can see in conjunction with the time and sales, and that's really the key to it, if you like. That's sort of micro tape reading when you're looking at the flow, you're looking at the order book, the depth, the market, the ladder, and you're seeing how that relationship to the time and sales, if they're streaming red, they're streaming green, is that affecting the price and stuff like that. So we haven't got time in this video to go in depth with that, but that's something you can do. Okay, no. Why would you not need it? Well, there's a lot of noise at level 2, really noisy, lots of stuff going on. If you consider price is just one input, price is changing up and down, and you've got your patterns. Level 2, you've got multiple different variables there. You've got your bid side, your ask side, your time and sales. You've got that changing. You've got people putting orders in and out, different sizes. A lot more noise there, which potentially can be a hindrance for some people. You can get the same info from a quote and chart. Now, I'm going to kind of be cautious with that statement because you can't get obviously every single bit of info, but you can get a good summary from using the chart. So you've got a quote screen, you can see if it's going up or down. You can see price lifting up, price lifting down. You can just see the price changing, 45, 46, 47, 48, 45, 40, and you can just see. And if you've got a chart as well, you can see if it's holding at support. If it's a lower time frame chart, especially like a tick chart or something like that, you can see the market comes down and sits there and ticks. You can kind of see that something is holding the price there instead of trade going through it. But it's not breaking through, so you can surmise that potentially there might be a reloader or someone holding it. So you can get a summary. If you wanted to go that deep down on the time frame, you can create a synthetic, if you like, not quite the right word for it, but almost a synthetic level 2 by going right down to a kind of really low tick chart, having a kind of quote board there and kind of seeing and gauging. And sometimes you'll see like price, running up, tick, 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 comes down, and then it will kind of sit there, lots of ticks, and that would be perhaps, a held bid or a reloader at the bid, and then they might take off again. So you can frame trades around that. You're not going to get the full info, but you can get some info and kind of make a reasonable assumption of what's going on. The other thing about no is that it shakes you out of positions. You can be in a position, you get a lovely little trade, and then you see something on the level 2 screen, like someone holding the offer, and you're like, oh, I'm going to come out, I'm going to ditch it. And that could just be a temporary thing. At the end of the day, guys, short-term readings on this, they will get run over in a heartbeat by the higher time frame. The higher time frame will rule everything on the bigger scale. If there's a big uptrend going on the daily chart, and we're pulling back and we're kind of going high to low, and it's a good trend on intraday as well, if there's someone standing in front of it, it might stop it for a bit, but it's not going to stop everything. So you can get sucked into thinking, oh, that's the turn now for the next hour, when in reality it might just be pausing things for a little bit, and it can shake you out of a good position. And the other thing is it encourages over trading. If you're constantly looking at that, you're constantly seeing opportunities that maybe aren't there. Maybe there is a big buyer, maybe there is a held bid, maybe there is an opportunity to jump in, but in the bigger picture, all it's going to do if it holds is it's going to sit there and drift. Maybe there's nothing on the higher time frames. So I think you've got to be careful of that. Now, listen, there's guys out there who are day trading very successfully and never even look at level 2. And there's guys out there who just focus purely on level 2, looking at that market depth and making decisions from that. And there's hybrids of the two. There's no right or wrong. All I want to do is kind of highlight in this video whether you really need it, whether you want to go down that rabbit hole or not. Ultimately, it's your decision. I'm sure some guys will chip in the comment section below as well and say whether they find it useful or whether they don't. But there's some ideas for you and some thoughts, some yes or no's, whether you should get level 2. All right, guys, take care. Whatever you're doing, keep your risk managed. Bye-bye.